The results are in and rates are unchanged. And on the back of this and a very upbeat quarterly refunding announcement, yields pulled back, stocks rallied, and it was a very, very bullish day. But we also got a ton of other data. ISM manufacturing came in horribly and the economy is slowing. And in the year of bad news is good news, we need to talk about what happens when bad news is bad news. Hello ladies and gentlemen, welcome to the daily recap show where we talk about stocks and the financial markets. If you like this video, please subscribe, hit the notification bell, let's get into it. And today's rally was led by big tech. We saw, the biggest names in the world, Apple, Microsoft, Nvidia, Google, Amazon, all really moving higher and taking the whole market with it. There were pockets of green in semiconductors, software. Financials caught a bid too. Visa up 1.5%, but it wasn't all green. There were pockets of red in energy, industrials, healthcare. And if we move on to the sectors, we can see the worst performing sectors were staples and energy. The best performing was infotech and communication services. We got the latest smart money confidence data. In this sell-off right here over the last 3 months, smart money were buying aggressively. And if you actually look at the dumb money chart, dumb money were selling. And that's very telling. In the last 3 months, we've had 3 red months and most of the selling was done by dumb money, while smart money was picking up all of their shares. And you have to understand this, guys. Pullbacks and volatility is what you have to accept when you put your money into the stock market. 10% corrections occur once per year on average. In fact, 1.1 times you will get a 10% pullback from peak to trough in the stock market, okay? Stocks don't do this, they do this. And then we move higher. And what we saw was actually a very orderly pullback. I know a lot of bears were calling for 2022 lows, but you have to play the probabilities, and pullbacks present great opportunities. We pulled back to the 17.1 range for PEs. But when you look at a chart like this, you look at the 10-year average, the 5-year average, and you say something like, stocks are looking pretty attractive. And if you had bought at the start of this week, you're probably already sitting up on your money. Now, if you're a long-term investor, you are also looking at metrics like this. EV to free cash flow, forward earnings for 2025. And you can actually see here that Tesla is only trading at 38 times. But then you have stocks like Apple trading at 21 times, Meta 17, and Google 15 times EV to free cash flow. Let's dive a bit deeper into Google. For 15 times EV to free cash flow multiple, which is one of the valuation metrics I like to look at, on a 15 times forward earnings basis, 2025, you're looking at a 19% growth on net income. And then you have a look at their balance sheet, their liabilities right here. Long-term debt, $13.8 billion. Cash and short-term investments, $120 billion. Other current assets, $15.4 billion. Just a fantastic balance sheet. So you're looking at a company that's incredibly solvent, okay, is growing at 19 times their net income over the next 3 years and has an average miss of 2% and has growing and has past growth of 20%, with a company that pretty much has a monopoly on search. And in situations like this, when Google is down 12% to the lows from the peak, you need to take advantage of this. You need to look at the long term, 2024, 2025, and hit the buy button right here, because that's how long-term wealth is made. Always have to remember, be greedy when others are fearful. Warren Buffett, the greatest investor of all time. Now, let's talk about we got a quarterly refunding update from Jerome Powell, and pretty much what Powell told us, that it's risk on into 2024. Okay, we're going to break down some of his comments. So I put this on Twitter. Go ahead and follow me here, guys, on Finfluential X on X or Twitter, whatever you want to call it. So pretty much in Q1, the Treasury made a significant change, upping the coupon auction size to $348 billion from $338 billion in the prior quarter. But it's important to note that the initial guidance was $396 to $460 billion. So long story short, still a lot of issuance, still up from last year, but lower than expected guidance. This is a shift in response to a tough 10 to 30 year auctions this quarter, prompting the Treasury to pivot towards bills. Long story short, the Treasury is finding it really hard to sell 10 to 30 year bonds. So what are they going to do? They're just going to sell bills. They're going to sell these short duration treasuries because people don't want to take on duration risk. While this adaptability might boost assets in the short term, it's going to lead to longer term structurally high inflation. So for now, based on this situation, it's probably risk on, but in the long term, this is definitely gonna hurt the market. But for the year now, what this pretty much means is risk on. And if we actually go into the Fed fund rate futures, Powell said that they're going to keep the cash rate target at 5.25 to 5.5, at their current effective rate of 5.33%. This is where we are right now, and then we're looking at the first possible rate cut as early as the end of March towards April, and then probably, rate cuts all the way through to 2024. Now, we also got this data from Bloomberg. Next year will be dominated by rate cuts, and they predict that rates will be lower in pretty much all of Western countries, US, Canada, Australia, most of South America, most of Europe as well. We now know that the entire curve is starting to flatten out. Rates as a whole on the day moved lower based on the announcements. You could see the 2-year note went from 5.1% all the way to 4.95%. And this bodes really, really well for risk on assets. And as a long-term investor, you're looking at charts like this, equity risk premium. And you can see here that stocks weren't looking too good in the equity risk category. You're probably only getting about 2.1% extra gain per year for taking on the additional risk that comes with stocks and the volatility. But with rates probably flattening out and potentially moving lower next year, you could probably see equity risk premiums move into the 3.5% to 5% range, where it usually is. And again, that bodes really, really well for risk on assets. Moving on to earnings, we had PayPal today. A lot of these hypergrowth names, Supermicro, Solar Edge, Airbnb, Etsy, all reported earnings today. Particularly PayPal, pretty good earnings. They were bid up after hours. We've had a very good earnings season, and price action is starting to support that. We saw AMD come in very, very strong, up 10% on the day. Market definitely liked their earnings, and that's why you always got to look at the fundamentals. And you can see 70% beat rate for Q3 2023 earnings, 914 beats, 386 misses. PayPal right here beat EPS by 7 cents. Really, really good. So we have positive news from the Fed, from rates, great earnings, but what about seasonal factors? We've been looking at this chart for the last 4 days. This is the October to November turn, the last 2 days of October and the first 2 days of November. We've actually been following the seasonality really, really well. It's a fairly positive week, returning upward of 1.85%. Normally on the 1st of November, we get a huge pop, nearly 1% up today, and the S&P 500 was up about 1%. Very, very accurate on seasonality. And we could probably expect more into Thursday, 1/4% increase with normally 12 wins, 6 losses, but we have come very, very strong in this week. So if we do sell off or see some trepid action tomorrow, don't be surprised. But that being said, we've looked at this the last couple of days and it's been very, very good for us. And it looks like we're about to make it 18-1 for the week again. What do we expect for the rest of Q4? This is some end of year stats when January to October is positive year to date, but August to October is negative. We can expect a 5% return. Normally November we return about 2.5% and about 2.5% again in December. 15 wins, 3 losses. Now here's a line chart of the November market performance, and what we normally see, as we did today, we get a pop into the start of November, sideways movement to the middle of November, a little bit of downward momentum into the back portion of November, and then we get a strong rally in all indices. So right now we're tracking seasonality perfectly normally. Now our game plan was to buy in the 4125 to 4150 range. Price was above this level by this date. Now we did front run this a little bit, at least I did, but that's okay because I told you guys I am buying. I told you I was a buyer 3-4 days ago as the market moved lower, and it's been a really good trade so far. Now we said we were looking to buy in this key support zone. We came, it held, so we entered our buys. We did enter them prematurely as well, and I said on Monday, Tuesday that I want to see the S&P 500 take this 4200 area, use it as support. It did that. Then I also said yesterday I want to see the index take the 4250 area. It did that. Now I want to see this act as support for the rest of the week, and I want us to stay above here for potential move higher into November, into December. We're above some very crucial levels. The next crucial level we need to take is this level right here, the 4,300 level right there, because it's a psychological level. People love that. From there, it should be a pretty quick run up, because if we look at the year-to-date chart and the volume profile, you could see that we're currently in a high volume area right now, entering this high volume area. And if we take 4,300, okay, that's the top of that high volume area. And from there, it's pretty low volume all the way up to about 4,400, which is the next high volume area. So if we take 4,300, market makers are probably going to move price to where the next high volume node is, and that is the 4,400 area. But for now, let's not look too far into the future. We do need to keep above this area for the rest of the week and look to 4,000, 4,300 towards the end of this week, at the start of next week. Those are the next targets. But let's move on to dark pools now. Now QQQ, triple Qs, we said 349 was a very key area. We said that on Monday, we said that last week, and look what happened. Price came here, tested it as support, tested it again, and then we rallied up. So 349 is now a very crucial level. We did see some big buys come in. The amount of trade that happened here was not equivalent to all of this right here, so these positions could still be open. You know, we thought this could have been a sell. Again, it was a buy. So, you know, I'm looking at the price action. When you look at it and you zoom out a bit, these are still very good buys at very good levels, looking for a Q4 rally. Moving on to the S&P 500, we saw some phantom trades happen there, and just, you know, big trades came in, and we all know they were buys, they were positional trades. And we did see some lit trades happen there, as well as dark pools. Again, not as big as any of these, but still notable trades happening at the highs. Equal weight. Now, this is very, very interesting right here. We did see the second largest trade come in. No trades happening here for the shorts. So one thing we did say was that the 136 level was very key. We broke above it, but there was resistance met right here. So into trade tomorrow and Friday, what I really, really need the market to do is break above this level, which it has, and use this level as support to move higher. That's how we confirm this is a buyer and not a seller. One thing I also want you guys to note is that the biggest trade since inception, both the first and second biggest trade since inception, number 1 and 2, happened at the lows of the 10-year treasury. And this was on the back of what Powell said with rates and quarterly refunding. People are starting to add duration to their portfolio because they can sense that rates is really high. It's having a huge impact on the market. We saw ISM PMI data came in very, very terribly. I believe it came in at like 46 to 47 around there. Terrible data for the manufacturing, ISM manufacturing. It's very likely that this right here was a short that was on the 10-year. They closed it off, as well as other traders, other big traders, dark pool traders entering longs in this position. And also the XLK, the technology fund. The 8th biggest trade happened right here, and very similar to the RSP. What I want to see is this level, take the XLK, come up here, take it as support, move higher. That's how we know that these are probably buyers who are positional traders. Otherwise, they probably took their trades off here and here. But if we do just like blast through this level in the next few days, next few weeks, we do know that either this trade was closed or it was a buyer. But this week's data is not over, guys. So we had the refunding, Fed share talking, ISM manufacturing, ADP payrolls, which came in shocking, by the way. So the economy is definitely slowing, guys. ADP dumped, and this is one of the reasons why we're probably going to get rate cuts next year, because, you know, the data is starting to come in really, really badly. The economy is slowing, unfortunately. I know it sucks to say that, but it is what it is. Thursday, 2nd of November, we got initial jobless claims. We do have a couple of other key metrics here: factory orders, labor costs, and productivity, but mostly initial jobless claims is what we want to be looking at. And if this comes in shocking, it's really going to be, you know, supportive to equities and for rate cuts next year. Now, if you guys have watched up until here, thank you so much. I appreciate every single one of you. Please go ahead, guys, like this video, leave a comment, share it around with your friends, subscribe to me. You know I love you guys.